Billionaire investor Ray Dalio is warning of a $34 trillion debt hurricane impacting the US economy right now. With every passing second, the storm is getting stronger, and when it finally hits, the fallout will be felt for generations. In Dalio's view, we are at the beginning of a very classic late big cycle debt crisis in this country. Just take a look at the level of US debt right now. As you can see, this staggering level of debt is constantly expanding, every hour, every minute, every second, right in front of your very eyes. In fact, since the start of the COVID pandemic in early 2020, the debt has exploded by 45%, reaching its current eye-watering level of $34 trillion or $267,000 per US taxpayer. Dalio believes that this level of debt is a ticking time bomb that could go off at any time, with devastating consequences that could change the economic landscape in the US for decades to come. In this video, we'll cover why Ray Dalio is so concerned about the current debt levels, what this means for you as investors, and what Dalio says you need to do right now to avoid being wiped out by the expected market crash. But before we do, please don't forget to subscribe to the channel to stay updated on the latest global financial news and money topics that can help you build your wealthy life. Okay, let's get started. At the time of creating this video, US national debt is at historic levels. As the debt piles up, the interest costs to finance the debt are growing and growing. And right now, net interest on the debt stands at a whopping $810 billion. But how did we get to this point? Well, the government has expenses it needs to cover each year for things such as social security, education, highway maintenance, and military equipment. By themselves, these expenses would already cost the government a significant amount of money. But when you add on top of that the money the government has spent in a desperate attempt to keep the economy moving during and after the global pandemic, the capital required to keep up with such spending is astronomical. The government earns income in the form of federal income tax, but when it's spending more than it earns, a budget deficit results. To pay for this deficit, the federal government borrows money by selling marketable securities such as treasury bonds, bills, notes, floating rate notes, and treasury inflation-protected securities. All of these securities pay interest to its investors, which the government must pay. The national debt is the accumulation of this borrowing along with associated interest owed to the investors who purchased these securities. As the federal government experiences recurring deficits through spending more than it earns, the national debt grows. While it is not uncommon for governments to borrow money to finance spending, as you can see from this chart, the US national debt has grown significantly over the last 40 years or so. Adjusting for inflation, US national debt has increased from $4.2 trillion in 1983 to $34 trillion at the end of 2023. That's an almost 700% increase in only 40 years. And Ray Dalio believes that the US is now near an inflection point, with the acceleration of debt creating a supply-demand problem due to several interconnected factors, which we'll cover here. As the US government spends more money, it needs to create more debt to pay for its expenditure. It does this through selling securities such as government bonds. This increased issuance of government bonds floods the market with supply. As you can see from this simple demand and supply chart, when the supply of bonds increases, there's a greater supply of bonds available for investors to purchase. As the supply curve shifts out, from S1 to S2, the price of the bonds fall. As bond prices fall, yields, the interest rate the government pays to bondholders, rise to compensate investors for the decreased price they are willing to pay for the bonds. Higher yields make bonds more attractive to investors, but also signal higher risk. And as interest rates rise, due to these supply and demand dynamics, the net interest costs the US government must pay to service the debt increases. As we mentioned earlier, the government spends money each year on things like social security, education, highway maintenance, and military equipment. Its budget for these expenses is $6.5 trillion. This means that the current level of government debt is over 5 times the size of its annual budget. Not only that, but the $810 billion interest the government must pay on that debt amounts to 12% of its yearly budget. Just on servicing its debts. That's $810 billion that could have otherwise been spent on education or social security. And that interest is increasing minute by minute, meaning the US government must continue to allocate more funds to pay the interest, diverting resources from other essential areas. The $810 billion in interest equates to an approximate interest rate of 2.4% that the government is paying. We were able to calculate this by dividing the current interest expense of $810 billion by the $34 trillion of outstanding debt owed by the government. Now imagine that the interest rate on that debt increases to 5%. The government would now be paying $1.7 trillion of interest each year, or 26% of its budget. Then imagine that the interest rate increases to 10%. This would increase the government's annual interest payments on its debt to $3.4 trillion. In other words, in this scenario, the government would be spending over half of its annual budget each year just to service its debts. As you can see, this situation becomes extremely unsustainable very quickly, if not managed carefully, and unfortunately, it gets even worse. To review how sustainable a country's level of debt is, economists compare total debt to that country's gross domestic product, or GDP. GDP essentially measures the output of an economy, or, put another way, the total value of all goods and services produced by the economy in a year. In 1980, US debt to GDP stood at 35%. In 2000, it had grown to 58%, but in the last few years, it has shot up to record highs, reaching 123% in 2023. In other words, the US government now owes way more money than its economy produces each year. Now, to get around this debt issue, the government could increase taxes to bring more income in. But as you know, the US will elect its next president this year, and the likelihood of tax rises during an election year are next to zero. The other option is therefore to print more money. The increased money can help pay for the debt, but this will only bring temporary relief. An increase in the money supply in the economy without a corresponding increase in goods and services can lead to inflation, as the purchasing power of the currency decreases. And as you will know, inflation is already a serious problem in the US economy in 2024 and is still far from being under control. Printing more money can also have significant consequences on the value of the dollar, as high levels of government debt can undermine confidence in a country's currency. If investors fear that a government may default on its debt obligations or resort to printing more money, they may sell off the currency, leading to a devaluation. A weaker currency makes imports more expensive, contributing to inflationary pressures and reducing the purchasing power of domestic consumers and investors. US imports were $320 billion in 2023, meaning that a weaker dollar and higher import prices can have a significant impact on inflation. As Dalio warns, printing more money prevents a big debt squeeze from happening by devaluing the money. That is, inflation. Now, while this all spells bad news for the US government, you may be wondering what impact it will have on investors. Well, according to Ray Dalio, history and logic show that when there are big risks that the debts will either 1. Not be paid back, or 2. Be paid back with money of depreciated value, the debt and the money become unattractive. In other words, during periods of high debt and high inflation, debt instruments such as government bonds become less attractive to investors because they become riskier, as there is more chance of a default. And locking your money away for a period of time allows inflation to eat away at it, reducing your returns. To explain this fully, let's introduce Michael. Michael is a prudent investor trying to navigate a period of high inflation and declining stock prices. Michael has $10,000 to invest and, worried about an expected recession, invests in a 2-year government bond with a fixed yield of 5%. After 2 years, the bond will mature and Michael will receive his initial investment plus interest. After the first year, Michael earns interest of $500. In the second year, Michael earns interest of $525, meaning a total return at maturity of the bond of $1,025. During the same 2-year period, the US stock market crashed 20%, so Michael is feeling pretty good about his choice of investment. Unfortunately for Michael, he's forgotten to factor in inflation. Inflation over the 2-year period was 4% per annum. This means that instead of earning a 5% return per year, Michael's real rate of return over the period was actually only 0.96%. All thanks to the devastating impacts of inflation. And as a result, his real return from his investment was only $193, $832 less than Michael originally thought. And this is why Ray Dalio is so cautious about investing in debt right now. So, given this, what does Dalio think you should be investing in? Well, Dalio has stated that he's holding on to gold as a buffer against risks stemming from higher inflation and the debt crisis hitting the economy. In his words, gold is a non-debt-backed form of money. It's like cash, except unlike cash and bonds, which are devalued by risks of default or inflation, gold is supported by risks of debt defaults and inflation. That's the main reason Dalio says he has gold in his own investment portfolio, calling it a good diversifier against the backdrop of high debt levels. Not only this, but gold has been on a record-setting price run in the last 5 years, rising from a price of under $1,300 per ounce in 2019 to its current level of almost $2,400 per ounce. That's an 85% increase, and as a result, many investors have been keen to buy the precious metal amid the looming risk of recession and inflation remaining stuck at elevated levels, as well as fears of wider geopolitical turmoil out of the Middle East. Let's take a look at why gold is seen by Dalio as such a good investment right now. Gold has long been considered a safe haven asset, especially during times of inflation and when government debt levels are high. This is because it has strong preservation of value. Inflation erodes the purchasing power of currencies like the dollar, and as paper money loses value, gold becomes more attractive as a store of value. Unlike paper currency, gold's supply is finite. This means that as investors seek gold to preserve their purchasing power, demand outstrips supply and the price of gold shoots up. Gold also has a strong track record of being an excellent inflation hedge. During the 1970s, when the US faced high inflation, gold shone as a top inflation hedge. And when oil price shocks and energy shortages drove average annual US inflation to around 8.8% from 1973 to 1979, gold delivered an impressive 35% annual return. So let's now revisit the example of Michael to demonstrate why, instead of investing in a US government bond 2 years ago, he should have invested in gold. As a reminder, Michael invested $10,000 in a 2-year government bond paying a coupon of 5%. Michael's return on his investment was $1,025, but thanks to a 4% inflation rate, Michael actually only earned $193. Now let's look at what Michael would have earned if he'd instead invested in gold. As you can see from this chart, 2 years ago, the price of gold was $1,957 per ounce. 2 years later, and the price has increased to $2,390 per ounce, an increase of 22%. So, had Michael invested his $10,000 in gold 2 years ago, it would have grown to $12,213. Even after factoring in inflation of 4%, Michael's real return would have been $11,391. That's about $1,200 more than if he'd invested in a government bond. Clearly, investing in gold yielded Michael a significantly higher return compared to investing in the government bond, even after accounting for inflation. Gold's ability to preserve purchasing power and generate higher returns during times of high inflation is what makes it such an attractive investment option right now. So, There you have it, the reasons why Ray Dalio is so worried about the current levels of US national debt and the strategies you can follow to grow your wealth, even during such economically challenging times. If you want to learn more about the current state of the economy, head on over to this video where I show you just that. Thanks for watching, and until next time, keep building your wealthy life.